Welcome to The Explainer. Today, we are going under the hood of a market crash. And I don't mean we're going to talk about headlines or panic. Nope, we are talking about the machine itself. We're going to peel back the layers and understand the actual mechanics of how all that market value can just seemingly vanish overnight.
So let's kick things off with the one question everybody asks during a crash. And the answer, well, it's a bit of a mind bender. The truth is, the money doesn't go anywhere. Because, in a way, it was never really money to begin with. See, the first thing you have to get your head around is that the trillions in market value we hear about isn't actual cash sitting in a vault somewhere. It's just a calculation. You take the last traded price of one share and you multiply it by all the shares that exist. So when that price falls, the total calculated value just, poof, vanishes from the ledger. No cash actually moves. But, and this is the part that really matters, the real-world consequences are immediate, and they are severe.
And that is the central paradox right there. A stock price is just a number. It's an idea of what something is worth. But that idea is tied to things that are very, very real. We're talking about loans, margin agreements, collateral. When that fictional price changes, it triggers all those real-world obligations in an instant.
A crash completely flips the script on what the market is even for. In normal times, it's a machine for discovering the long-term value of a business. But during a crash, that all goes out the window. It becomes a machine for one thing and one thing only: finding immediate cash, finding liquidity. The price is no longer about what a company is worth. It's about whatever it takes to find a buyer, right here, right now.
So who are these people selling at any price, these forced sellers? They aren't investors who suddenly had a change of heart about a company's future. No. These are systems hitting their breaking points. We're talking margin calls getting triggered, automated funds being forced to de-risk, banks trying to reduce their exposure. It's all rules-based, mechanical selling that has to happen no matter what the price is.
Okay, so if prices are plummeting because of all this forced selling, and not because the companies themselves are suddenly terrible, well, that sounds like a massive buying opportunity, right? This is where so many investors walk right into a really dangerous trap.
I mean, you look at the numbers, and on paper, everything looks like a screaming deal. The price-to-earnings ratio, the dividend yield. Arithmetically, they all look way better. But the problem is, those numbers are telling you a story about a world that, in the middle of a crash, has just ceased to exist.
And here is the absolute heart of the trap. That P/E ratio compares a company's price to its earnings. Well, during a crash, the P for price updates instantly to reflect a very scary new future. But the E for earnings? Oh, that's from last quarter. It's a report from a bygone era of stability. The price is a leading indicator. The earnings are a lagging one.
This sequence just lays it out perfectly. It all starts with fear. That fear causes asset prices to fall, like right now. That fall in prices makes credit harder for everyone to get. That credit crunch then hurts real-world demand. People and businesses stop spending. And only then, at the very end of this chain reaction, do we finally see corporate earnings collapse. The E is the last domino to fall, long after the price has already hit the floor.
And this creates another really insidious problem, right on the company's balance sheet. You might think a lower stock price is just a market thing, but it's not. The amount of debt a company owes, that number stays fixed. But its equity, the value of the company's stock, just got hammered. So all of a sudden, that company is way more leveraged and way more financially fragile than it was just yesterday.
All right, let's move on to the next layer. Let's see how all of this starts to connect, creating these feedback loops that actually allow a crash to feed on itself. This is how it turns from just a market event into a systemic one.
And this brings us to a really important distinction. Look, a stock price falling, that's just numbers on a screen changing. The real damage, the permanent destruction of value, that happens when a company actually goes bankrupt. That's the moment a paper problem becomes a real-world catastrophe, usually because the credit markets freeze up and cut off the loans that company needed to survive.
And this is exactly how the contagion spreads. It's not about feelings or investor sentiment. This is pure mechanics. It's a chain reaction. Company A's failure hits its lender, Bank B. So Bank B tightens the screws on everyone else. That causes Company C to get into trouble and lay people off, and on it goes. This is balance sheet contagion, and it can ripple through the entire economy.
Now, this contagion is driven by a few really nasty feedback loops. First up, you've got the margin loop. Prices fall, which triggers margin calls. That forces more selling, which of course pushes prices down even further, triggering even more margin calls, vicious cycle.
Next up is the volatility loop.
As the market gets more chaotic, automated funds that are programmed to target a specific level of risk are forced to sell to reduce their exposure. But here's the kicker. Their selling increases the chaos, which then forces even more of these funds to sell.
And finally, maybe the most terrifying one, the liquidity loop. See, everyone just assumes they can sell whenever they want to. But in a crash, they discovered that they are all trying to get through the same tiny little exit door at the exact same time. That illusion of liquidity just evaporates, and prices have to gap down violently just searching for anyone, anywhere, who's willing to be a buyer.
Now, what's really fascinating is how all of these mechanics have a particularly brutal effect on the darlings of a bull market. You know, those high-flying stocks that just seem priced for absolute perfection.
When you see a stock with the PE ratio of, say, 200, you're not paying for the business as it exists today, not even close. You are paying for a trajectory. You're making a bet that its earnings are going to explode tenfold in just a few years, which is the only way that valuation ever comes back down to something that looks reasonable.
But what happens if that amazing future you paid for just doesn't show up? What if the company survives, maybe it even grows a little bit, but it doesn't deliver that exponential explosion in earnings? Well, the entire theory behind its valuation doesn't just bend, it shatters.
The risk here isn't a gentle drift downwards of 10 or 20%. No. If that stock simply gets repriced to a normal market multiple on its current, disappointing earnings, you could be looking at a 90% drop. It is a catastrophic snapback to financial reality.
This isn't just normal investment risk. It's a special kind of risk we can call latent gravity. Think of it as this massive, hidden weight that's being held up only by a story about a perfect future. The moment one of the assumptions in that story breaks, gravity reasserts itself, and it does so violently.
So, with all these insane feedback loops and this latent gravity pulling everything down, it raises a really important question. Why doesn't the market just go all the way to zero? What actually makes the crash finally stop?
And the answer, once again, is mechanical. A crash doesn't end because everyone suddenly gets optimistic again. It ends because the fire literally runs out of fuel. The forced sellers, well, they eventually run out of things to sell. Prices fall so far that long-term strategic buyers start to see generational bargains. And often, governments or central banks step in to stop that credit contagion. The selling just exhausts itself.
So if you take one thing away from all of this, let it be this. A crash isn't really a mass delusion or some kind of moral failing. It is a rapid, violent, and mechanical repricing of all assets. It's the system adjusting to a sudden, dramatic reduction in its capacity to carry risk. It's simply the machine resetting itself.